job and so on and so forth, or people may, you know, decided not to buy the new home when the economy, doesn't go well. All right. Therefore, as you can see that even the CAPM, the CAPM assumptions, are not realistic. However, the calculation of the CAPM still be very useful when you use to estimate cost of equity capital, right? So we use the CAPM, the CAPM to estimate the oops, sorry, why I cannot to estimate the cost of cost of equity capital, right? So you estimate, you use the CAPM to estimate cost of capital. Okay, once you know the beta that measure the market risk. Okay, and what else? So thank you very much for helping me to do so. Okay. For people who have done, you can submit it to me, send me email like that so that I can give you some bonus point. For people you haven't done it, you want to do it, you can also still do it and submit it to me by email. Okay. All right, so now let's go to the main lesson that we learned yesterday. We learned that again, people may say that the perfect capital market is not, is not real. Is it true? It's not real. However, the theory of capital structure still hold for perfect capital market. Okay, and then we adjust the uh, when the market are not perfect today. Okay, we're gonna see how the theory of capital structure still hold or not. Okay, so what the main idea that we discussed yesterday? We discussed about the Modill-Miller propositions. Okay, especially proposition number 1 and proposition number 2. Okay, and this proposition is, if you want to recap, we just say that, Professor Modill-Miller says that no matter what, you change the right hand side of balance sheet, your right hand side of the way the company finance your asset, the value of the asset on the left hand side remain unchanged. Okay, as you order, a pizza, or one side of pizza. Once you order, okay, that pizza, you have already paid at a given money. Okay, you're gonna get the size L of the pizza. No matter you're gonna cut, to 2 to cut to 4 inside your family or friends, it should not change. The size of the pie cannot be bigger or smaller, right? That is what he explained. Professor Modigliani got the Nobel Prize in 1985. He explained, how these capital structure work. Okay, Professor Miller got later on the Nobel Prize in 1990 together with Professor Markowitz, who proposed the theory of portfolio and Professor Sharp ratio. Remember Professor Sharp? His name is not Sharp ratio, right? His name is Professor Sharp, who proposed the the, the Sharp ratio. Okay, of the slope of the line. Okay, so yesterday, the most important one is about, the proposition number one, where it says that the value of the A should be equal to the value of the U should be equal to the value of the D plus E. Okay, so it means like they say that the total value of the firm should be equal to the total value of the cash flow generated by its asset. Is not affected by a choice of capital structure. In other words, the value of the firm, the value of asset A should be equal to the value of the U. The U is the market value of unlevered firm. Each firm does not has doesn't have any or finance everything by equity. Okay, the value of firm without debt we call unlevered firms. However, if firm, okay, has decided to uh, finance by several degree of debt, okay, and they said that the value of the D plus E should be equal to the value of U equal to the value of A, which is the case when we look at this together. If the value of the project, remember, the project invest with the project cost of capital of 15%, the value of the projects will be always 800 plus 200, which is 1,000, right? 1,000 is should be the market value of this project. Okay, and the value of the project or value of the company, because this company has only one project, should remain at 1,000. So therefore, if it's 1,000, you don't finance, you finance everything by equity, the the return to the unlevered equity should be equal to 15%. Okay, which is come from this calculation. However, if you change your capital structure, okay, for example, change to 500 and the E should be 500. That is proposition number one for Martin Miller. Okay, so, and then we see that the risk to the levered equity holder compared to the risk to unlevered equity holder are not the same, right? The increase of risk, okay, the increase of risk, as you can see here, right? The return when the strong economy is 75% compared to minus 25. The variation between strong and weak economy make levered equity, riskier. So therefore, investor who hold the stock of levered equity should require a higher return, okay, which is in this case 10% extra financial risk premium that they require. Okay, Professor Martin Miller proposed that the amount of increased risk, okay, should be equal to the risk premium that calculated by D over E multiplied by RU minus RD. The cost of capital of levered equity is equal to the cost of capital of unlevered equity plus a premium that is proportional to the market debt equity ratio. Okay, so because of the increased risk, right? All right. Tuk, tuk, tuk. This one we have already discussed. Okay, if a firm is unlevered, all the free cash flow generated by its assets are paid to its equity holder. The market value risk and the cost of capital of the firm asset and its equity coincide. The cost of capital for the project should equal to the return that is available on other investment with similar risk. if we identify comparable firm whose asset have the same risk as the project being evaluated, and if the firm is unlevered, the equation above imply that we can use equity cost of capital as cost of capital for the projects. Okay, so usually when you are going to, for example, if you are you are the CFO of Sabeco, the beer company. If the company, okay, decided to, you know, make a real estate project, let's assume that they're gonna diversify their business. Okay, can you use the beta of 0.254 to evaluate the project, the new project that the company, the beer company, will gonna do the real estate business? The answer would be no, right? Because the risk of the project in the new business can be, can be completely different than the average risk of the beer company at the moment. Okay, so therefore, what we have to do is, in that case, is to find out the comparison firms, comparable firm. For example, you can take the Windhome as example, as a proxy of the risk of your new project, and then you use the risk of Windhome as a proxy of the risk of the new project that the beer company will gonna do. Okay, I have my last question to. So that is exactly what I have just discussed. With perfect capital market, a firm WACC is independent of its capital structure, is equal to its equity cost of capital if it is unlevered, which met the cost of capital of its asset. Therefore, if the risk of the project matches the risk of the asset of the firm, so therefore you can use the firm WACC to estimate the appropriate cost of capital for the project, but it's not always, right? So that I just want to remind that we also discuss it in the problem set, question number 10, if I'm not wrong. Okay, so let me ask you a small question before I go a little bit further. Oh, I have some question. Perfect. I have a question about risk-free rate. I read the method of divided nominal risk fee rate by inflation. Yes, you can use um, the real interest rate and the nominal risk-free rate. However, notice that the inflation in Vietnam is higher than the government bond interest rate. So the real interest rate will be negative. In actually, the real interest rate is negative almost everywhere at the moment. Where we are in a very low interest rate phenomenon around the world, where the real interest rate is negative. Usually, you can apply the risk-free rate without adjusting the inflation rate, the nominal risk-free rate in the equation. I'm not sure whether we should adjust inflation. Let me think about it. When I mm, Let me think. I'm not 100% sure, but normally we don't need to adjust the inflation rate in the risk-free rate in the CAPM formula. Okay, use the nominal risk-free rate. May I ask you a question? So if I say that the interest rate, okay, related to this question, very interesting. Let's assume that if the company can borrow, okay, and the cost of debt is 5%, okay, where my cost of equity is 15%, okay, and the bank come to see you saying that, wow, the company should, lower. Can you lower company cost of capital by increasing issue more debt? Okay, so somebody come, okay, this is a situation where the cost of debt is 5%. Cost of equity is 15%. You have, ideas that, okay, you want to benefit the lower interest rate to get the RD equal to 5%. Okay, you would like to borrow more. So when you borrow more at the cost of debt at 5%, you're gonna be able to lower company cost of capital. This statement is true. Everybody follow me? No. Tong Lien Tan said is no. Why is no? Because you have cost of debt is lower. Okay. So therefore I should borrow more, like the case that we have in this example, right? Oops, where is that? Yeah. When I used the debt of 500, when I use the debt of 200, when I use zero debt, the my cost of capital, my RWAC remain. I should my WACC should reduce. Yes. Tong Yen Tan, can you? No. Tong Yen Tan, you change your mind? Anyone? I just make you confused. Because my company cost of debt is low, so I should borrow more so that I can lower the overall cost of capital. Is this statement right or wrong? I think it's wrong. Very good. Tong and Tan, you have already answered the right answer. Exactly. Based on proposition, what is still missing in my statement? What you cannot say, because when you borrow more, the D, right? When D increase, the risk to E, to equity level equity also increase. RE should change. proposition say that if we cannot change, we'll change exactly proportionally. said the RE will change exactly proportionally to compensate the increased risk. So therefore, the RE goes up, when you increase more D, even the RD is small, okay, RE will goes up, therefore the RA or the R WACC remain unchanged. Okay, this is exactly what Martin Miller propositions tell us. Okay, so therefore increase your debt with a lower cost of debt does not necessarily, okay, would lower the company cost of capital because RE will change. The risk to equity holder, the levered equity change. So therefore, increasing cost of debt is not necessarily increase the debt, okay, with lower cost of debt does not necessarily, lower the company cost of capital because RE's change. Okay, the RE goes up because the risk is higher. That makes sense? Is this clear? It is a common mistake that most of the people, mixing up and don't understand, okay, and often forget about the risk, the increased financial risk to the levered equity holders. Yes, it means for no. Yes. Okay. Perfect. All right, perfect. This is exactly I often do ask the question in the exam, okay? Because if you understand this well, you should know this. This is a common mistake for the people who don't know or who don't study the Martin Millers. This is why is his propositions, their propositions are very powerful. Except that the market may be not perfect, but I can prove to you that even the imperfect market, capital market, Martin Miller propositions still hold. Okay, let's continue. Do you have any questions? So I also have I think I have asked you to work on one questions, which is the question number 10. Yeah. All right. The question number 10, Unidas system has 40 million shares outstanding, trading for $10 per share. In addition, Unida has 100 million in outstanding debt. Suppose Unida's equity cost of capital is 15%, its debt cost of capital is 8%, corporate tax rate is 40%. Okay, so what is the cost of what is the value of the E? Remember, all that we're talking about here should be based on market value of asset, market value of debt, market value of E, market value of equity, which is E, market value of debt, which is D, and the market of asset, which is A. A should be equal to D plus E. So the market value of E should be 40 million multiplied by 10, which is the market cap of the company is $400. The debt outstanding is $100. So in practices, sometimes because some company don't issue bond, so we can assume that sometimes the book value of debt equal to the market value of debt. okay, because we don't know the market value of debt or bank loans, okay. Now the RU should be equal to 13.6%, which is the RWAC, which is the RWAC equal to the RU, okay. So the RD, if I take the effective the effective cost of debt, we're gonna be 80% multiplied by 1 minus tax rate, which goes down to 4.8%. So the RWAC with tax, we're gonna be 12.96%. Okay, so the RU equal to 13.6%, which is the after the tax deductible. So our goes down to 12.96%. Considering a project with a free cash flow of 1 year of 90,000 in a weak economy, 117,000 in a strong economy. With each outcome being equally likely, the initial investment required for the project is 80,000. The project cost of capital is 15%. The risk-free interest rate is 5%. Suppose you borrow only 30,000 in financing the projects. According Martin Miller proposition, what is the present value of unlevered equity cash flows? What will the firm equity cost of capital be? What will the project weighted cost of capital be? All right. So what we have to do, you first read and then you write. After, if you don't know how to write, you reread. After you read, you try to write. If you don't know how to write, come to see me next year because you're gonna fail this class and you retake the class. No, I'm kidding. Everybody should pass. Okay, so let's start. Help me to write. Okay, I'm on this screen, so could you please help me to write? So I have the cash flow of 90,000, 117,000. I have initial investment of 80,000. The project cost of capital of 15. The risk-free rate is 5%. So what is the present value of unlevered equity cash flows? The unlevered equity cash flows should be equal to what? So what you have to do is to calculate the expected cash flows, right? The expected cash flow should be equal to half of 90,000 plus half of 117,000, okay, divided by 1 plus R. What is the R? The R is what? 5% or 15%? The expected cash flow is 133,500. What is the R? If it's if is the project, okay, this is very important. When you are going to discount your cash flows, if the cash flow, okay, is the project's free cash flows or the project's expected return or the expected cash flows, you should discount with the project's cost of capital. If one day you are going to do firm's cash flows, is a firm cash flows. Firm cash flow come from several projects that the company, running. So therefore, you have to discount with firm's cost of capital. If you are doing valuation for merger and acquisition, if you use equity cash flows, you're gonna discount it with equity's cost of capital. That makes sense? Okay. Same when you do the cash flows to debt holder, you discount it with the cost of debt. This one, what the discount rate you're going to use? If I want to answer the first question, the present value of unlevered equity cash flows. What the discount rate I should use? I should use 15%. Thank you. So if I use 15%, so my present value should go to 90,000. Okay? Meaning what? Meaning that the market value of the project right now is 90,000, right? Because the project generate additional value. The project is a positive NPV project that generate a NPV of, what is the NPV of this project? What is the NPV of this project? Is 10K, because if it is, minus 80,000, the project has the, additional value, okay, to generate value added of 10,000, okay, and this 10,000, okay, goes to the project by increasing the market value. The book value is 80,000, right? Because 80,000 is the I0. So the project has the market value of 90,000, okay? Once the project has 90,000, okay, if I want to know what will be the firm's equity cost of capital be if I borrow 30,000. According to the Miller proposition, what I have to do is I go to the formula of proposition number 2 here. The RE will gonna be equal to the RU plus D over E multiplied by RU minus RD. Okay, I have already know what is the RU. RU in perfect capital market, according to Martin Miller proposition, RU should be equal to the RWAC. RWAC should be equal to 15%, right? This 15%, okay, I can simply plug it in this proposition, Monty Miller proposition number 2 equation. I gonna be able to compute that by borrowing 30,000 out of 90,000 of the firm value, okay, I gonna have the RE increase from 15% to 20%. So it means the investor, the equity, lever equity require 5% additionally to compensate the increase of financial risk of borrowing, of having 30,000 debt. Okay, so therefore, the RE, which is the firm equity cost of capital, would be 20%. What will be the project weighted cost of capital be? You can calculate the RWAC, but if you don't calculate it, you don't need to calculate the question number C. You can say that in Marty Miller perfect capital market, the project's weighted cost of capital should remain unchanged because it's the same project. You can still use the same machine. The machine we're going to generate exactly has a same capacity to produce the product, to sell and generate the project free cash flows. Okay, so but if you calculate it, you're gonna get also 15%. Okay, which is should be, because this one is exactly the same formula. All right. Okay, now okay, question number 12, I will stop. Now, any question? We're gonna do something more fun now, too. All right. If there's no question, I gonna continue. Okay. I can show you this. Okay. This is the graph that show the the debt to value ratio and the cost of capital. Okay. As you can see here, in the perfect capital market, the RWAC, okay, which is the yellow line, remain unchanged. The cost of debt, okay, when the debt to the leverage is low, okay, the likelihood to default is low. The cost of debt may keep unchanged, okay, keep unchanged until they have increased the default risk, okay, and therefore the RD may going up. Like the remember the our case. So the if you borrow zero, okay, and the RWAC is 15%, RE is 15, RD is 5%, okay, where the D is zero. So the E, when you increase to debt to 200, RE increase from 15% to 17.5%, RD remain unchanged, right? Because it's always risk-free. And then the RWAC remain 15%. If you borrow 500 and if you borrow 900, and you can see that the debt holder require additional risk to compensate the default risk. So therefore, the RD may goes to 8.3%, where the RE is extremely high because the risk is very high for the for the equity holder, lever equity holder. However, the RWAC remain at 15%. Okay. Is it clear? Very, very interesting illustration of these figures for checking your understanding. Now, let's go to example that is, very close to the real world. Okay. Suppose, for example, the company EP El Paso Corporation is a national gas firms. The company has today market to debt equity ratio of 2. Suppose its current debt capital is 6%, its equity cost of capital is 12%. Suppose also that if EP issue equity and use proceed to repay its debt and reduce its debt equity ratio to 1, it will lower its debt cost of capital to 5.5%. Okay, because the debt holder will ask to to reduce that cost of debt because the risk to the debt holder is also lower because you refinance some of those existing debt with equity, so the capital structure reduce, right? The debt to equity ratio change from 2 to 1. With perfect capital market, what effect will this transaction have on EP equity cost of capital? Okay, so what you have to do is you first read and then you write. Okay, let me see whether I don't have the screen that with me. Okay, let's do it here. So if I have my debt, I have, oops, so let me draw it here. So I have market debt to equity ratio of 2/1. Okay, let's see like this. Okay, let's change. All right, so my debt is green, my equity is blue. Okay, that is kind of before. Okay, that is before my decision. Now I would like to what? To equity chain my capital structure by issuing more equity so that my new capital structure, okay, now I read and then I write. But since I would like to clarify more, I can draw as well. Okay, I can draw where I know that now the ratio of equity, okay, debt to equity equal to 1. Okay, I gonna have my additional, okay, I increase my equity, okay, to that it gonna be, it gonna happen like this. Is it right? So if I gonna probably write other things, what I can write, I can read and then I can write, right? Before my RD is equal to 6%, let me make it a little bit up. Because normally I can write on the screen directly, but my computer here today is not the one. So my RE, okay, is equal to 12%. Is it right? So the question asks that if suppose my new RD go down to 5.5%, okay, because the debt holder consider that the risk they take on the new structure is smaller. They decided to, lower a debt cost of capital to 5.5%. Okay, the bondholder consider that it is, better in term of risk, and then therefore the cost of debt of capital is 5.5%. Example, in the real world, the S&P may upgrade the bond of this company to a better bond rating that can lower down cost of debt from 6% to 5.5% in this case. Okay, the question is what it should be the RE and what it should be the RWAC of the company. Everything is clear to you guys? So this is how things that you read it from problem that allow you to work. I think it's easier when you draw like this, right? When you write it like this, is much easier. Okay. I come back to your question later on. Okay. So is it clear for my picture? Is this clear? So before, okay, EP company has cost of debt of 6%. Cost of equity capital is 12%. Suppose the company issue new equity, so I increase my equity proportionally here. I increase to the debt to equity ratio, okay, equal to 2. Okay, so if I write completely, I can write it as well. D over E equal to 2, where here the D over E equal to 1. Okay, now the rest is simple, right? So I can use the I can use before RDRE D over E to be able to calculate the RWAC. Okay, the RWAC should be equal to E over D plus E. I have three proportion. I have one proportion of the E. Okay, this is the capital structure of D over E equal to 2 multiplied by 12% plus 2 over 3 multiplied by 6%. RWAC is 8%. So RWAC is 8% in the perfect capital market. Okay, the company remain doing the same business. The risk of the asset remain unchanged. So therefore, the RWAC of after this refinancing program should remain unchanged. So the RWAC should remain at 8%, which is the RU equal to 8%. If I want to know what is the RE, I can simply using the proposition number 2, where the RE equal to the RU. Oh, okay. I thought that I forgot to record it. So I have already recorded, or Lynn already recorded for me. So equal to 8% plus 1 over 1 D over E, which is the new ratio now. 8% minus 5.5%, which is equal to 10.5%. That does make sense. When you have unlevered, you have 8%. When you are, you reduce, so your cost of equity reduce from 12%, RE is 12% before, should go down to 10.5%. They go down to 10.5%. Okay. The reduction in leverage will cause the EP's equity cost of capital to fall to 10.5%. With perfect capital market, the EP's WACC remain unchanged. If you calculate the debt, the WACC one more time, you're gonna be able to get that the WACC is still remain at 8%. Okay, so that is how we can, make deleverage and leverage. You're gonna see later on that the way you deleverage or leverage here would allow you to do, for example, in valuation of firms, you can use this type of exercise. Any question? Is it clear? Perfect. Thank you. All right. So this is the very important important company strategy when they are changing their capital structure on the right hand side. How that interact. The many people make mistakes because they forget that the equity capital or RE always change due to the capital structure or due to the leverage. Okay, we call that leverage effect. Now, if the effect of lever on the risk of a firm security can be also expressed in terms of beta. Okay, the effect of leverage on the risk. Okay, you can use the beta U, beta E, and beta D here to understand that you increase the D, the BE should increase, right? The BE, which is the market risk to the equity holder should increase when the D increased. All right. So the unlevered beta is a measure of the risk of the firm as if it did not have leverage, which is equivalent to the beta of the firm asset. If you're trying to estimate the unlevered beta for an investment project, you should base your estimate on the unlevered beta of firm with comparable investment. Example that I have just given. Okay, so therefore, if I want to know how much the beta E would be affected when you change your capital structure, you can apply proposition number 2 of Professor Martin Miller to estimate your beta E. Okay, example, if the CVS has the equity beta of 0.8, the debt equity ratio of 0.10, estimate its asset beta, assuming its debt beta is 0. Suppose CVS were to increase its leverage so that its debt equity ratio was 0.5. Assume that its debt beta was still 0. Okay, they are still in the risk-free zone. What would you expect its equity beta to be after the increase in leverage? It should increase or decrease or unchanged. Obviously, when you increase your leverage, the cost of equity capital, okay, should increase. So I can do exactly the same type of exercise. Okay, so therefore the beta U, okay, I can calculate this way. I get 0.7533 that represent unlevered beta. Unlevered beta, meaning that the market risk when firm doesn't have that. Okay, with the increase in leverage, okay, you can apply Martin-Miller proposition number 2. The beta E will gonna be equal to the beta U, which is 0.73 plus D over E. Okay, D over E is 0.5 multiplied by the beta U minus the beta D. So we're gonna get the beta E equal to 1.09. 1.09, that increases from 0.73. It is clear to you guys? Okay, so therefore, when you are doing, for example, comparables, okay, sometimes you can, you observe the beta. So sometimes, for example, remember my beer company. If the beer company going to use the Win Home to evaluate their new project in the uh, new line of business of the beer company. Okay, sometimes you cannot use the beta of the Win Home directly. So most of the time when they have those kind of, comparable firms, they're gonna use the Win Home and then they first unlevered those company first and adjust their capital structure later on with your capital structure of your new company. Okay, when you observe the beta of other firm directly, sometimes can be mistaken because the company that you use, okay, they may highly leverage. Sometimes they can lower leverage. So the effect of the capital structure may make your beta estimation of your comparable company, okay, different from the value. In most of valuation techniques, we often unlever first, and then we assume that the beta U of the Win Home should be equal to the beta U of your new project, okay, because the business risk is the same, and then you plug the D to your level of the leverage that you're gonna have in your new company. You follows? Everybody follow me. Yes. Okay. Which is also another, important element when you do comparables. When you observe something, you have to make sure that your capital structure effect, or we call the leverage effect, taking into account on the uses of your value. Okay, it is very important. All right. Now, Another example, which is about cash and the cost of capital. In July 2012, Cisco System has a market cap of 102.4 billion. You see, when you read like this, you can write immediately, right? So this is what? The E. E equal to 102.4 billion. It has debt of 16.2 billion as well as cash and short-term investment of 48.6 billion. Its equity beta was 1.23 and its debt beta was approximately 0. What was Cisco's enterprise value at that time? Given a risk-free rate of 2%, a market risk premium of 5%, estimate unlevered cost of capital of the company. Okay? So because Cisco has 16.2 billion in debt and 48.6 billion in cash, remember I introduced you yesterday that you should use the D should be the net debt because the investors, the bond investors or rating agency, they take into account on these cash positions of the company. Okay, because in case of bankruptcy, the company can use cash to pay their debt obligation. All right, so its enterprise value was 32.4 billion, which is say 70 billion. So the company even has a better position because the borrowing is still even lower than the position of the cash. Even zero beta for its net debt, so the beta U go to 1.80. So A beta U is equal to 1.80. I can simply apply the CAPM with the beta of 1.8. Okay, that goes to the 11%. Note that because of its cash holding, Cisco equity is less risky than its underlying business. All right. Okay. So we are almost done for the chapter 12. Okay. So I will probably skip this. Okay, if you have time, you can read the slide number 34, 35, 36, 37, 38, 39, 70, 41. Okay, you can skip from the slide 34 to 41. Okay, page 34 to 41 is just only for your reference, for fun for you. I will not include it in the exam. They're just simply talking about the policy of leverage and earning per shares. Okay, that a lot of people use and make some mistake on it. Okay, but I don't think that is important to discuss here. So please, we skip from 34 to 41. Okay, I'm gonna introduce you now the capital structure in an imperfect market. That is also probably related to your questions. In question number 11, they are the same. Can you please explain? So I come back to your question later on. Basically, the question number 11 is a little bit too early. I have to introduce you tax first to be able to clarify the question number 11. Okay, I leave it like that and then let go for the slide first with tax, and then I come back to the question 11 one more time. Okay, now let's take the capital structure in an imperfect market. Okay, which is about debt and taxes, the cost of bankruptcy and financial distress, the trade-off theory, agency cost and information, and some other capital structure theories that I would like to introduce to you, which is called the pecking order theories, and the market timing theories. When the markets are not perfect, we call market imperfections. The market imperfection or imperfect market can create a role for the capital structure. Right now, Monty Miller in the capital structure, perfect capital market, says that the capital structure does not matter. In the real world, it may matter. Okay, we're gonna see how, whether, and how the capital structure may be affected for market imperfections. One of the very important about market imperfections that we know, which is the government. The government set rule of the game for many things. One of the game that they set up, and very important that they keep changing all the time and carefully monitor this policy, which is about taxes policy. The one of the very major tax policy that the government should consider, and then they revise and so on and so forth, which is called corporate taxes. The corporate taxes, okay, they have also, all the government have the rule of the game, but the universal rule of the game that we have, that we know, is about the interest expenses you pay to the debt holders. The government says that the corporation can use those interest expenses to deduct the corporate tax that they're gonna pay to the government. Meaning what? Meaning that when you use this interest rate to deduct your corporate tax, so you're going to reduce tax paid. So it means that you increase the amount available to pay to investor. You increase the value of the corporation. That's why the capital structure may matter, because it may affect to the cash flow, okay, that you pay less to the government. And this government who give you this benefit will increase the cash flows to the investor. They also increase, therefore they increase the value of corporations. Okay, that I only take the bright side of the debt, and this benefit is known as the interest tax shield. Interest tax shield. Okay. All right, I just introduce you this, and you're gonna see later on that is no free lunch. When you get benefits, you also have costs that come with. Okay, corporation pay taxes on that profit after interest payment are deducted. Therefore, interest expense reduce the amount of corporate taxes. This increase incentive to use debt. Let's take example, consider Safeway Incorporated, which has earning before interest and taxes approximately 1.8 billion, and the interest expense of about 350 million. So the marginal corporate tax rate was 35%. Okay, so it meaning that if the company decided to have zero debt, without debt, on the right hand side, as you can see, 1,850 minus zero interest expense, you're gonna have income before tax of 1,850. So the government will charge you based on earning before taxes, which is 35% of 1,850. So therefore, your net income, okay, is 1,202. That's fine. Now, if you have EBIT exactly the same thing, you're gonna pay 350 million as the interest expense. As you can see that income before tax goes down to 1,500. The tax you're gonna pay to the government reduced from 648 to 525. And then this is exactly how we can see, okay, that the debt obligation reduced the value of equity, but the total amount available to all investors was higher with leverage, right? If you take 1,202 plus 0, the value total available to all investors is 1,202. Interest paid to the debt holder is 350. Income available to equity holder is 975. So therefore, the total available to both debt holder and equity holder or investor is 1,325. Without leverage, the company was able to pay out 1,202 million in total to its investor. With leverage, the company was able to pay out 1,325 to both debt holder and equity holder. Where that this additional 123 million come from, okay? And this is what we call the interest tax shield. The interest tax shield is the reduction in taxes paid due to the tax deductibility of interest. So therefore, the interest tax shield can be calculated equal to the corporate tax rate multiplied by the interest payment. In our case, the gain is equal to reduction in taxes with leverage goes to 123 million, which is 350 multiplied by 35%, okay, which is 123 million. Okay, let's take another look in another company called DFB. The marginal corporate tax rate is 35%. What is the total amount of interest tax shield the company gained from year 2006 through 2009? All right. So as you can see here, the EBIT, okay, is changing. The interest expense of 50, 80, 100, and 100. You can see that the income before tax is 719, 770, 777, 817, and 900, and so on and so forth. The amount of the tax you pay, okay, which is 35% of income before tax. If I want to calculate the interest tax shield, I can simply take the interest expense line, which is 50, 80, 100, and 100. And this one, since I pay less tax at the marginal tax rate of 35% of this amount, so I can have 17.5 interest tax shield in 2006, 28 in 2007, 39 in 2008, and 39 in 2008, with a total additional interest tax shield of 115.5 million. If I want to calculate the present value of interest tax shield, I can discount all those interest tax shield as of year 2006 to know what is the present value of interest tax shield. All right, it's very simple and very straightforward. When the firm use debt, the interest tax shield provide the corporate tax benefit each year. This benefit is computed as the present value of the stream of the future interest tax shield the firm will receive, right? So therefore, if I take the cash flow of lever firm paid to investor will be higher than would be without leverage by the amount of interest tax shield. If the cash flow to investor with leverage should be equal to the cash flow to investor without leverage plus interest tax shield, right? This is how we can illustrate the the world of unlevered firm as compared to levered firms where you can get benefit of interest tax shield, which is this part, because the amount of the tax you pay of by the levered firm is much smaller than the corporate tax paid by the unlevered firm. Okay, if I take the proposition number 1, okay, where the A equal to the U and equal to the A equal to the U equal to the D plus E. Okay, let's rewrite it. That the VL, which is the levered value, okay, should be equal to the U plus present value of interest actual. It says that the total value of the levered firm exceeds the value of the firm without leverage due to the present value of the tax saving from debt or interest actual. All right, so I will do the example later on. Just want to, I talk a lot. Maybe I would probably take opportunity to ask you question. Do you have any question? Okay, I introduce you first market friction, which is called taxes made by the government. The tax provide benefits to the firm because they provide interest tax shield. Okay, so if I take the VL equal to the VU from Bonnie Miller proposition number 1 in the perfect capital market. Okay, in the imperfect capital market, it said that the value of lever should increase with the interest tax shield. Present value of interest tax shield. Okay, that's it. That is about the corporate tax, how the corporate tax, the tax deductibility of the interest tax deductibility provide company or provide incentive for company to have debt because these interest actual. All right, we can learn later on after the break that this is always true. Okay, in that case, the company should borrow 100% to maximize their interest tax shield. The answer would be no, no, no. Why is no? Because there's no free lunch. If you have the benefits, they also have costs that associate with this decision. We will come back after the break to discuss about other cost that may come when you increase your leverage or try to maximize your interest actual. Okay, we have 15-minute breaks, 15 to 20-minute break. Okay, and then we're gonna come back. All right, so as usual, I gonna probably show you the Eiffel Tower. The weather today is also very, very nice in Paris. So, oops, do you see? Because the camera tried to take my, you see that, okay? So my break time is your Eiffel Tower, okay? All right, see you. I break the record. Oop. Yeah. All right. So if you have the interest, okay, that the company will gonna pay $100 million in interest each year for the next 10 years. Now, for example, you are going to, borrow 2 billion in 10 years. So you repay the interest every year for the period of 10 years. If you want to know the value of its interest tax shield, you can just simply calculate the annuity formula here, right? Everybody see this formula, right? So it's very easy. You can have 100, 10 times is going to be equal to 35 million multiplied by this factor, okay? And you can have the present value of interest tax shield of 270 million. Do we have interest tax shield on the principal of 2 billion? 2 billion of the principal? The answer would be no, because the repayment of principal, the government said that this is not tax deductible. So therefore, it does not contribute to the tax shield. The government only allow the corporation to enjoy the interest tax shield or the tax deductibility on interest payment, not the repayment of the principal of 2 billion US dollars. All right. Typically, the level of future interest payment is uncertain due to changes in marginal tax rate and amount of debt outstanding and the interest on that debt and the risk of the firm. For simplicity, we will consider special cases in which the above variables are kept constant. So meaning that let's assume that the company will keep the value of the D constant over time. If the D is constant over time, or it constant, it keep the debt permanently at the level of D. So therefore, if the firm marginal tax rate, okay, and if the debt is riskless in the risk-free, assume that it's a RF, the interest tax shield will gonna be the amount of the D multiplied by the interest rate, which is the interest rate multiplied by the corporate tax rate. So you're gonna have the tax shield. Okay, if I keep the D forever, I can enjoy interest tax shield forever. I can apply the perpetuity formula to calculate the present value of interest tax shield, which is equal to the interest tax shield divided by the RF, which is the discount rate. For this, we're gonna make this a corporate tax rate multiplied by the D. This is the case where you keep D forever and you enjoy interest tax shield forever. If the debt is fairly priced, no arbitrage imply that its market value must equal to the present value of the future interest payment. Okay, so which is exactly what I've just described. Okay, so if we come back to the WACC formula, remember, if I have the WACC with taxes, okay, I can have my RD multiplied by 1 minus tax rate. If I rearrange this one, I gonna see that my RWACC right now declines. Okay, you can lower your cost of company cost of capital, okay, in the world with taxes, due to the interest tax shield. The amount of reduction due to interest tax shield is this term. Okay, that is make the RWACC go closer to the real world. If I show you the graphic, you're gonna understand much better here, right? So remember the dashed line represent the world without tax. Okay, but if you have the taxes, the more, okay, you increase your debt, the higher interest tax shield you get. The between the yellow gap here, the dashed line and the normal line, you can see that these are in the interest tax shield. You're gonna reduce your WACC from pre-tax WACC with the WACC with taxes. You're gonna maximize your interest tax shield when you borrow 100%, right? Because this one, you can lower down your debt cost of capital. However, the equity cost of capital still in the same. So we compute the WACC as a function of leverage. In the previous slide, without taxes, the WACC is constant. With taxes, the WACC decline as the firm increase its reliance on debt financing and interest tax shield grows. Okay. The next question that we ask is, in that case, if you want to maximize interest tax shield, the company should borrow 100%. Is right? If the company borrow 100%, why they don't do so? Why you cannot do so? We're gonna introduce you now the new chapter we call the financial distress, managerial incentive, and information. They should have some other reason beyond interest tax shield that may incentivize company not to borrow 100%, isn't it? And one of the very important costs associated with debt is we call financial distress cost. But they have other costs that let me introduce you the financial distress cost first. What is a financial distress? Okay, so the cost of bankruptcy and financial distress if you increase your debt. Okay, obviously, when you increase your debt, you increase the value of the firm. But why not shift to 100% debt? With more debt, obviously, there is a greater chance that the firm will default on its debt obligation. All right. The problem when you have difficulty to pay your debt obligation, you're going to give your power in controlling your company to your debt holder. The debt holder will going to have the right to do something with the company under the bankruptcy law. So therefore, a firm that has trouble meeting its debt obligation, we call the company is in financial distress. Even before going bankrupt, when you bring the company, you're starting to miss your debt schedule. Okay, you company, we are in the situation of financial distress. So obviously, if the bank has a customer in financial distress, they have also in trouble, right? Because they have to keep it recorded. If you're starting to continue not to pay the interest to miss your debt obligation, if you go to certain month, okay, you're gonna have to consider as the NPL, non-performing loan. So you have to put reserve, you have to do all those regulations that impose company to or banks to do so. All right. So let's talk about the cause of bankruptcies. The cause of bankruptcies and financial distress have two types. One is we call direct cause of bankruptcy. What is direct cause of bankruptcy? Each country has a bankruptcy code designed to provide an orderly process for settling firm debt. However, the process is still complex, time-consuming, and costly. Outside professionals are generally hired. The creditor may also incur costs during this process. They often wait several years to receive the payment. When they have the NPL, the bank have also need to bear those costs to make a reserve. In the US, the average direct costs are approximately 3 to 4% of the pre-bankruptcy market value of total asset, likely to be higher for firms with more complicated business operation and for firms with large number of creditors. That is the case of the bankruptcy. Somebody know the process of bankruptcy or when the company in, do you know something called the Chapter 11? Have you heard something about Chapter 11? Somebody heard about, before I ask you Chapter 11, I have a question. In the case of debt that change over time and has a lot of debt with different debt rate, how can we calculate cost of debt and cost of capital? Okay, so we can calculate cost of debt and the interest tax shield based on each debt, right? Because as long as you are able to calculate the interest paid on your debt, okay, you're gonna be able to calculate the overall total interest debt that you pay by different type of debt with a different debt rate. Okay, so for example, remember on the beginning of the slide, where is that? Yeah. So as you can see here, this is the total interest expenses from that may come from several debt and several debt rate. So what you have to do is you can break down, okay, in case of they have changed debt over time, you calculate like that year by year, debt by debt, and try to get the total interest expense, and then you calculate interest tax shield based on the real interest expense that you have made. Okay, the more difficult one is when you want to go for the future debt. When they're talking about the permanent debt D, we assume that if you want to calculate the overall of the total present value of firm that can enjoy interest tax shield, if you assume that D is constant at the as the level of D, but if you cannot assume because of the chain of the interest over time and so on and so forth, it means that you would not be able to apply this perpetuity formula. That's it. Okay, but you can still calculate exactly with the number with your forecast of your future debt. Okay, but at some point, if you don't want to forecast based on the different structure of debt, different rate, and so on and so forth, you can assume at one type the average of debt and the average cost of debt that the company may have. Is this clear, Quang Dan Fan? Okay, you can just simply calculate that without using the shortcut formula like perpetuity formula. That's it. Okay, so anyone know what the chapter 11? Have you heard something about chapter 11? Anyone know chapter 11? The bankruptcy code is part of US bankruptcy law. Due to COVID, I think that if you work in the bank, you're gonna have more and more cases where you're gonna apply equivalent type of what we call chapter 11. Anyone know the chapter 11 that in most of the country have this one? Anyone know? For reorganizing the firm? Yes, almost. So when the company in financial distress, okay, probably you can have kind of economic shock, economic crisis, COVID pandemic, and the firm is in distress. They are in trouble financially, okay? But maybe the economic value of firm is still there, right? Just only that you have a shock where the cash flow that you normally plan to pay the debt obligation, you cannot deliver it. Okay. So in the bankruptcy law in the US, in most of those, you can call it, you would allow the company to do what we call the financial restructuring, right? The financial restructuring. So for example, if you don't have chapter 11, what the US, what is the bankruptcy law is about. The bankruptcy law is that the lender or the banks can go to the court and ask the court to file bankruptcy, right? It is a traditional bankruptcy. When you file bankruptcy, it means that you're gonna ask the company to stop their operation, and you're gonna sell the asset, and you're gonna try to get the money back based on the sale assets of the bankrupt company. Okay, so now instead of going to that process that is can be not a win-win situation, because the company, the owner of the company will lose the company went bankrupt, and also the bank also may suffer from those value of the sale asset that is much maybe lower than the debt outstanding they have. So in the US or in other countries as well, they have something called Chapter 11. Chapter 11 is a kind of financial restructuring chapter of the bankruptcy law that allow you or the company and the bank to think about and find a common agreement to restructure the financial situation of the company. Okay, obviously the company is in trouble. Okay, but maybe we can find a solution that the banks or bond investors and the company, all of them can get benefit if we leave the company survive from bankruptcy. Okay, so the Chapter 11 can be asked. Okay, when you see, like, for example, when you do the traditional bankruptcy law, when the banks when the borrower could not pay their debt obligation for sometimes, the bank go to the court and try to go to the process of bankruptcy. However, in the Chapter 11, the borrower, the company, can go to the court and ask the court to protect the company from the banks who may want to, file bankruptcy, right? So, like Trump company, after 9/11, in the World Trade attack in the US, and then people stop traveling, and most of the airlines company, they have kind of negative shock on their cash flows, the debt obligation, they start to default, they cannot pay. So most of those airlines company in the US went to the court and filed Chapter 11. Obviously, the airline company, they can still continue working and operating, where they can ask the court to allow them not to pay interest, to continue to run their business. So obviously the court will evaluate your financial restructuring program, that most of the time you have the financial advisor of the borrower. You have also financial advisor of the banks. They can have several banks, and the bond or all the debt holder. They come up with a solution. They often, appoint a third party to come and control the cash flow over the restructuring process. Okay, and this one we call the Chapter 11. And you can see that the company that filed Chapter 11 during the COVID pandemic are huge. Okay, so obviously banks also don't want to lose their money. So most of the time, the financial restructuring can, come up with several possibility. Okay, anyone can give me some measures that they can come up when you do financial restructuring. What kind of agreement you can make to make the company survive from financial distress? Can you give me the several possibility when your company is in trouble? Obviously, you can extend the payment term of debt. For example, if the debt, will mature in the certain period, you can allow or you can extend the payment. You reschedule the payments that allow the company cash flows to do so. I remember before I left Thailand as an investment banker, I had the interesting experience during the financial crisis in 1997, 1998 in Southeast Asia, and most of the work we have done is on this, right? So you do financial restructuring. So most of the time, you can do the what we call the a payment rescheduling. Reschedule the payment. Can be interest and principal, interest or principal or interest. You can have some years where you allow company not to pay interest and so on and so forth. You can ask the corporation to raise new equity. Okay. Sometimes you can also ask the company to sell some of non-core business. Okay, so that they can focus on the core business, and the core business can enjoy the sale of those non-core business, okay, to use as a cash flow for your core business, to continue using collateral in business operation rather than letting it being foreclosed by creditors. Okay, I think that is related to my talk about core, non-core business, what kind of things. But the complicated one is that especially in the emerging market, most of business loan, they have collateral. Sometimes they have so many different type of collateral, but you know that the collateral it just only give you the different negotiation power when you do financial restructuring. Okay, but it does not help much on the financial restructuring program itself, right? So equity injection, extend scheduled debt, set governance, no dividend until sell asset with no use, focus on core business, helping them Team Jordan Nguyen, you are the best. So it's exactly what you can end up when you do those kind of financial restructuring or financial distress. Okay, so when you see here is that the financial distress is the situation where the company has to bear the cost of this financial distress situation. So therefore, the financial distress is not necessarily direct, like the case of sales of the asset and so on and so forth, right? So you can end up with the solutions, okay? And obviously, before you get solution during the period of financial distress, you company bear huge cost, and the cost that related to financial distress we call indirect costs, and these potential loss from indirect cost of financial distress has been estimated in US is even higher than direct cost of bankruptcy. Obviously, because firm may renege on both implicit and explicit contract, okay, many indirect costs may be incurred even if the firm is not yet in financial distress, but simply face a significant possibility that it may occur in the future. Okay, we can explain you later on like this so that you understand. For example, first, we call loss of customer. Why loss of customer? Because, for example, when you are going to buy a product that need to have after sales service of your products. So, example, you are going to buy a new machine, okay, for your new production line. Okay, you want to make sure that the product that you are going to buy, okay, they will have some service, some spare part in case of problem and so on and so forth. So some customer, when they look at the vendor or their supplier financial statement, if those company has are highly leveraged, obviously some customer may consider that, okay, buying that product, the commitment from supplier who gonna provide you service cannot be assured. So maybe you may choose to buy the same type of product from another company where the level of probability of financial distress is smaller, isn't it? So it means like you may lose your customer. When you lose your customer, it means you can reduce the firm value decline. Loss of suppliers, similarly, right? If you have suppliers who provide your raw material to your production, and the supplier may be unwilling to provide a firm with inventory if they fear that their account payable will not be paid by you. So you may lose some good supplier for good raw materials and so on and so forth. And also cost to employees. Most firms offer their employee explicit long-term employment contract. During bankruptcy, these contract and commitments are often ignored and the employee can be laid off. If you are employees in the banks, in the corporation where they are in financial distress, obviously you may feel like, okay, you're not sure about your employment contract. Before they ask you to leave, you may decide to go to another company to, ensure your employment contract, right? So the company may bear this cost of not be able to keep good employees in your company. Obviously, the fire sale of assets, company in this trade may be forced to sell asset quickly, so the value loss from selling asset quickly may be bigger if you have, time to do it. So all these financial distress costs are important, very important costs that may, help us to understand that the interest tax shield you can enjoy by having more leverage in the firm may be offset with the financial distress cost. If I take Monty Miller proposition number 1, I can see that the total value of lever firm equal to the value of the firm without leverage, because the VU plus the present value of tax saving from that less the present value of financial distress cost. This trade-off theory is very important theory that people use because these are the kind of major costs and major benefit related to capital structure. As you can see here, in the condition where the present value of interest tax shield is equal to the financial distress cost, even in a market imperfection, the proposition may still hold that VL still equal to the VU, like proposition in the perfect capital market. Okay, if this term, present value of interest tax shield, is exactly equal to the financial distress cost, so therefore the proposition in perfect capital market can still apply in imperfect capital markets. All right. So some people believe that is not true in the real world. You can still argue that it can still be true if the benefit is equal to the cost from those market imperfection. All right. So the key qualitative factor that determine the present value of financial distress cost are 2 factors. The first is about the probability of financial distress. This probability of financial distress depend on the likelihood that the firm will default. Okay, the increase with the amount of the firm liability relative to its asset, it increased with volatility of the firm cash flow and asset value, right? The volatility of the firm cash flow play a very important role. For example, if you are working in a startup company, do you know what the startup company means? Okay, when you do with the startup company, the volatility of a firm cash flow of the startup company is much higher than mature companies. When the mature company, you can easily forecast your firm cash flow. When you are the startup, it can be extreme, right? You can be a huge big cash flow in case of success of your startup business, or you get zero in case of is not you fail, the startup fail on that business. All right, so in that case, the volatility, a high volatile firm cash flows company, they would have a higher probability of financial distress than lower volatility of a firm cash flow of a mature company. So therefore, we can come that later on, that firm with high volatility of those, they usually have less debt. Okay, most of the startup company, they finance by equity because the capacity to be able or to avoid the financial distress, okay, is smaller. So therefore, most of the startup company, as you can observe, okay, use less debt. They are financed by equity. The magnitude of direct and indirect costs related to financial distress that the firm will incur depend relatively important of the source of their costs are likely to vary by industries. Some industries, for example, when they have more intangible assets, okay. Example, when you have more intangible assets, when your company goes bankrupt or in financial distress, most of those value of intangible assets will go away easily. So therefore, the magnitude of direct cost of bankruptcy or financial distress may be higher. So therefore, most of the company who have more intangible asset usually has less debt. Tomorrow, we're gonna come back, try to find out that if you are the CFO or the CEO of the company, what it should be my choice of capital structure, what it should be the optimal capital structure that I should have in the company. If you know your optimal capital structure, that we're gonna talk it tomorrow, you're gonna know whether the company under leverage or the company over leverage. Okay, what we are gonna try to find out is the D star. What is the D star? D star is the optimal level of debt. What is the optimal level of debt? The optimal level of debt is the level that which is optimal that occur when this value of lever firm is maximized. So it's the level of debt that you can maximize the firm value, the high on this mountain, right? The highest point that you can maximize your firm value based on your value of debt, and the value of debt of the D star that we can determine together tomorrow should represent the optimal level of debt. That will gonna lead you to, find out what it should be your capital structure strategy, yeah, to manage your company. All right, so far so good. To conclude for today, I propose the the new market imperfection from the proposition. I introduce one potential or one benefits of having debt, and one cause that associate with debt, okay, and the benefit this cause can be considered as a trade-off, okay. So if these we call the trade-off theories, okay. So that is exactly what I would like to talk for today class. We are 11:50 now. Do you have any questions? You have any questions? Yes? No? Clear? Very clear? Okay, great. So before I leave or we leave today, let me check what we can do in the homework. So you are great, huh? Your group is one of my best group. You're always on time and you're very active. That is great. So can you do question 11 one more time? Okay. Oh no, 11 are done. Question number 12, IFO corporations. And then question number 13, the present value of interest tax shield. Question number 14 as well, you can do it. Question number 15, you can still also do it. 16 as well. Until 16. Okay? 12 to 16. Question 12 to question 16. You should be able to do the exercise, the problem sets. Yeah. And then please remind me before our last sessions. We kind of decided together when we are here. I gonna contact Lynn to see how we should organize it. But my assumption that we're gonna do it, the exam online. I have to design and I can discuss whether it's applicable in Vietnam. And then, do you have any exam online before? Have you done it? Yes? Okay. It worked well. We had 2 before already. Okay. Perfect. So you have the exam on Canvas? Agent so many due to COVID via Zoom. Okay. Perfect. Okay. All right. So I will confirm you later, but I would guess that will gonna be the same thing, right? The Zoom platform for the exam. All right, perfect. So we also in Paris, in France, I did several online last year, so we get used to it now. Okay. I'm done with the course today, and tomorrow we come to the normal time in the afternoon, Paris time, and evening in Vietnamese time. Is it right? So, which is 2 o'clock in Paris, I guess is your, all right. Okay, and 7 o'clock in your time. Perfect. So I wish you all the best or for this Sunday evening, and have a nice evening, and then see you tomorrow. Okay? And tomorrow, if you want to show me your camera, okay, you can show me tomorrow. I can ask you to put on your camera to see other people again. Okay, if you want to make some nice dress and whatever, okay, feel free to do so. And tomorrow you can show your picture so that I can see you, live. Okay. See you tomorrow. Have a nice evening. Bye.